Hello, everybody. I've been putting off this video for days, weeks. Um, and it's not that I don't want to do it. It's just that I know maybe this much out of a huge strategy. And that strategy is selling spreads or selling options to make money. Basically, it's a credit position. You sell to get into the position, and either you buy it back cheaper or you let it expire worthless. You can do credit spreads, and they're actually just considered multi-position or multi-leg positions, meaning you have more than one option in the trade. So there are credit spreads. The reverse of that are debit spreads, which you buy the position, and hopefully it goes past your limits, and you sell it for more than you bought it for. But I'm going to concentrate on credit. There are butterflies as well. And a lot of it is based on volatility and time. There are several different options. There's many different options. You can trade these on any type of stock that has options. The downfall with anything other than the SPX, I believe that's the only one that's cash settled. Maybe the Qs, no, maybe the Qs and the RUT, the major indices, but EFTs, stocks, if you sell a position and let's say you sell a call and it goes above your strike price, the buyer has the option to exercise it. And if he does, you are obligated to fill his position. For example, if you sell a SPY call and the SPY rises above your target or your strike, you need to buy that SPY or the 100 shares of the SPY so that you can sell it to him because he's buying from you. Now with the SPX, it's cash settled. There's no settlements, or there's no exercising, there's no settlements, there's no assignment risk. There's basically just the the risk of the option expiring in the money, but you know that defined risk going into it. Like I said, there's another thing called calendars as well. I've done those as well. What I picked this up, there's simpler options, which I think is now Simpler Trading by John Carter. Bruce Marshall is one of his traders, and Bruce does what he calls a bias class. Bruce's income advisory service. Basically, it's a way to generate small income by doing these positions. And like I said, a lot of it is based on volatility and time. So if the SPX, I'm just going to concentrate on the SPX. So if the SPX just trades within a range, those options on either side are going to decay. So you sell it when there's a lot of volatility, the price has risen, and then if it stays within that range, those will decay and eventually get to zero, as long as your side or your position isn't threatened. I've learned two strategies as far as selling credit spreads. The first one is a weekly trade. It lasts for 7-8 days. You put it on Friday near the close, and you look for a delta 10 to 13. And as you progress days, it's going to lose money. Slowly at first, but then aggressively as the end of next week comes. The second one that I've been doing, but I gave up on it a week or two ago, is selling daily spreads on the SPX. And if you get threatened, you'll need to buy back that position, and that'll cost a day trade. So if you're under $25,000, 3-day trades a week, and you'll be in the clear. So let me show Thinkorswim. It's all based on probability, expected move, and trying to be outside of that, the move, either the daily move or the weekly move, whichever one you choose. So this is Thinkorswim. And let me minimize. Can I minimize me? Maybe I can pull me over in the corner. This is called a grid. And you can have as many charts or positions as you want. Theoretically, you could do like this. You could do like this. And you can save that grid. I have quite a few. I mainly stick with monitoring one stock, which basically puts the 5-minute, the daily, and the ticks. And the grid will save all of your studies on that chart and what time frame each chart is. So like I said, you can recall these grids, you can save them, you can share them. And like I said, I have a ton, well, a dozen maybe. I just don't use them anymore. I'm not as active as far as trading goes. So let's look at the SPX on the daily. And what I'm going to do, and like I said, remember, it's all based on the expected move. And I'm just going to concentrate on a single day. So there are several different ways to determine what the expected move is. So this is a trade tab on TOS, and every expiration has its implied volatility or expected move. And this changes over time, but it looks like this SPX, oh, this is a SPY. Okay, SPX. And it looks like it does. 3rd, 4th, 5th, 6th, 7th. So that is every day of the week. So every day has its implied volatility or expected move. So this first week is 53 points in either direction. So let's even numbers, let's say 50 points. So what you could do so the SPI is sitting at, or the SPX is sitting at 35.85. So 100 points down, well, 50 points down is 35.35, which puts it right here. And let me see if it gives me the delta, -22. If you guys realize, deltas on the puts are negative, deltas on the calls are positive. Because basically it just means for every move, 1 point move in the SPX, you need, let's say this is a delta 51. Means you need 2 of these options to mimic the move of the SPX. So, and calls are directly related or directly correlated. Puts are negatively correlated, and that's why these are negative. So 50 points. Let's round down to 35.30, which still a delta 20. Now remember, when I said that weekly move, you were looking at delta 13s. So these were as of Friday. Delta 13 or below, you can right click, sell a vertical, which basically you will sell. How did I get 35? Oh, 35.10, and you'll buy the 35.05. Now, what we can do with this trade, I'm not going to place it. You can analyze the trade. So, and this is the Analyze tab in Thinkorswim. Expected move, and then outside of the expected move. So, as long as the SPX trades within this thing, at expiration, you will make $55. And I'm looking at this. And it's not letting me highlight that. But if you notice over on the lower left, that as of expiration, the aqua line is $55, meaning that's what you sold it for, is $55 credit. We unlock this, it looks like it's 50. So $50. And this line, as the day progresses, as long as it stays within here, is going to move up and eventually mask this line. You know what? It's Sunday night. Let's go look at something. You notice how it jumped to the SPY? Because originally when I saved this grid, I was looking at the SPY. So it saves the tickers as well. So let's go look at the futures. Futures are green. So interesting. And like what happened to my trade? Oh, it's on the ES. SPX. So back to this. And notice how this is bouncing around. I wonder if the SPX trades 24 hours. Interesting. So that's one way to determine the expected move. 52, and as the days tick by, the expected move grows and grows and grows. So what's good for one day is not good for the next. And like I said, if we're looking at this Analyze tab, as this thing starts to tick, as the stock price starts to tick this way, you're losing money. That's what this slanted down purple line means. And if you blow past this break-even point, and actually it's hard to tell. Let's zoom this in. So this tick right here is your break-even. 35.0957. So I was wrong. 35.10 minus 50 cents is 35.0950. And remember at the beginning when I said you know your max loss? It is basically the difference in these strikes. 35.10 minus 35.05, which is 5, $100 minus the 50-cent credit, or $450. Now you may be asking, why would I risk $450 to make $50? Now remember, you have sold outside the expected move, okay? And when you put on these positions, it's important that if you start to get threatened, is to get out of them, to have a stop loss. And that's why I no longer trade them. The position would start to move against me. I'd have hope that it would reverse. I'd like to say, well, I'm not going to get threatened. It's not going to go that far down. Sure enough, it does. So this is a bull put credit spread. You're bullish, thinking it's not going to go below this point. It's puts because you're selling puts, and it's a credit spread because you're selling the position. Now, you can as well. So this will require, let's see here, if I can place it, let's see here, trade. Oh. See that confirm and send? I want to hit that. So if I confirm and send this, oh, this is wrong because this isn't my margin account. Okay. Credit of $50. And why did it change to 60? Let's drop it down. If you notice, you're getting more credit as we go along in this video. I think that what that means is the ES is starting to drop. As the ES drops, the S&P 500 futures, the SPX will drop. And as it drops, as it gets closer to your strike, it's worth more. You're putting more risk on. So back to confirming this. Let's see, can I? Okay. It tells you your break-even point, max profit, max loss, and your buying power effect. How much margin this is taking to put on. Okay, because that's your max loss. Thinkorswim's not going to, or TD Ameritrade's not going to cover your position. They want to know that you have the funds available to cover your max loss. And that's why you can't, let's see here. That's why you can't sell these naked. Let's delete this. That was a 35.10, right? And notice these are all green now. Let's say 35.10, we're just going to sell this. And we're going to do this in the margin account. Buying power effect. Negative $350,000. Why? Because you're putting a line in the sand at 35.10. This could theoretically go to zero. It won't, but it could. And that's why the 35.10 times 100 for the price, and then times 100 for the position size. That's why you need to buy this as protection. Now, theoretically, you could sell the 35.10 and buy the 3500, which is 10. But now you're risking $950. So that's how much you need to put up to put this trade on. Okay. What you can also do, sell a vertical on this side. You know what, let's do this in the Analyze tab. So we have this position, and we're going to add a simulated trade. So now remember, this was 35.10. Come on. Doesn't give me the delta. 35.10 is a delta 14 now. Remember, it was down to a 12. And let's see, a delta 14. Sell a vertical. I don't want to do that. 35.65 is a delta 13. So back to my Analyze, 35.65. Analyze, sell trade. That's wrong. And let's lock these together. Now you are making $105. And if I go and look at this trade, my max loss is still $395, which seems odd. Where are they getting that? Oh, because remember, you're $500 wide minus the credit, 105. And that's why it's 395. 395 plus 105 is 500. Here's the thing. You cannot, and that's the most you're going to risk. Why? Because at expiration, it cannot be here and here at the same time. It can only be one of these. If you're at max loss here, you are at max profit on this side. And this is what's referred to as an iron condor. It's basically two credit spreads put together. And like I said, as long as it bounces within here, you're okay. The best time to put these on are in the morning. But again, if you put something on the put side and it starts to threaten, you're going to start losing money. So in a perfect world, you'd want to time this so that if you think the SPX is at a bottom, it's not going to drop anymore, put on the credit spread. If you think the SPX is at its highest point of the day, sell a credit spread. Now, theoretically, you can even go out. So here's the way that I did it. I looked, so I would come in the morning. I would look at this 52 points. Notice how it went down from 53. As the day goes on, as Monday goes on, this 52 is going to drop as well. Why? Because its expectation, the expected move is going to get lower and lower as the day progresses. So what I do is I take this 52 and I double it, which is 105. So then I take 35.85 35.85 minus 105, 34.80. 34.80 is right here. Now look at this, is a delta 7. So I sell this 34.80 and I buy the 34.75 based on 105 points off of the current strike. Okay, 40 cents. That's kind of a lot. But then what I do Again, you can right click on any option and create an alert. I want to create alert when the delta is below, -10 and -15. When it gets to -15, that's a point where I would bail. And when you bail, you're going to have to probably buy it back for more than the $40 that you're going to make. But that's how I play it. I play the delta as soon as it goes either below 15 on a put or above 15 on a call, I consider getting out. I don't put physical stops where I just order a stop, and maybe that's my problem. But that's how I play these credit spreads. Anything else? Now remember, so we talked about credit spreads or verticals, and we talked about iron condors. There's also a group and they're in the tasty trade options who trade what they call these zero DTE credit spreads. Now, what you can do is search this group for pound JOIF. I think it's called the Jeremy Olson Iron Fly. And they do wide wings. Wings are basically where your other strikes are. Let's go look at selling a butterfly. And the way that they play those, 35.85. Oh, duh. Sell an iron condor where your short strikes 35.85, 35.85, and 35.80. We're going to do a 5 wide. And let's go analyze this trade. And let's get out of these verticals. Okay. Now this is a pretty narrow, and again, they're moving. Whoops. So 485. Okay. Well, like I said, this is pretty narrow. However, if I'm going to get this in the middle, if the SPX bounces around here, and that's why they do 50 wide. Let's go look at a 50 wide. So we're short 35.85. All this math so late at night. 85, 95, 105, 15, 25, 35, 36, 35. And 35.85 minus 50 is 35. 35. Okay. So basically what they do is they sell this near the open. Volatility's jacked. You have this hope. So what does this say? 45.15. 45.15. So it is balanced. It didn't look balanced to me. So what the hope is, again, is they can flip these relatively quickly. They sell it when the volatility is high, 45. As the day bounces around, this purple line comes up and they sell it for, or they buy it back for less than they sold it for. So those are the three different positions that I know of for selling. There's others, like I said, the calendars. But let's get back to the expected move. Because remember, this was one way. In addition, and really what this is, if you take the at the money call and put and add them in divided by 2, that's that value. That's what they're pricing in. Another way is to look on a daily chart. And let me clean this up. Here are these moving averages. You can look at the Bollinger Bands. Okay. See how we kind of ride up, come down, ride up, come down, ride down, come up, ride down. So if you sell outside of this Bollinger Band, odds are that it will not threaten. Now, there are cases where it does trade below it. So you kind of need to be aware of that. Another one that I have and I don't remember where I got this from, is a weekly expected move. And it's drawn on Monday. So let's back out of here. And if you look at this chart, here's one where we breached it. We breached this. Bounced within it. Traded above it. Bounced within it. This was a terrible one because we were below it. This week below it. This week above it. So what this is telling me is that, and let's go look at this indicator. If you, again, right click on this, edit source, this is ThinkScript. Someone wrote this. So they have expected move study, works with daily aggregation only. So what this is doing is, if the day of the week is Monday, it's taking the implied volatility the IV gap high, which I don't know what that is, times the square root. It's basically doing a mathematical formula based on this implied volatility. And let's go look at settings. Let's see what these are. Oh, that's just the highlighted. Well, that's the width. Never mind. What I was looking for is if they have coded for how much of the implied volatility, for instance, 1.5 times, 2.5 times AM's Q%. There we go. So expected move skew percent. I mean, we could jack this up to 100%. And again, if you look, there's still going to be some touches within this move. So that's what you can do as well. If you're trading more than just the daily. So I hope I hope this helps. Like I said, there's so much, so many different variations, but the object is the same, is to sell volatility and to sell time. And it's all based on math, standard deviations, expected moves, implied volatility, that sort of thing. You know, and as the VIX goes up, VIX is a indicator of volatility. As the VIX goes up, volatility rises, which means option prices rise, because the market makers need to account for that volatility rise. And I think that's what we're kind of seeing here. We've gotten these big moves. So like I said, this is just an intro. Let me know if you have any questions. If you want this study, theoretically, I could share this. Let's see here. SPX weekly, and actually, let's just do weekly EXP move. Okay. And if you guys don't know how those links work, basically you go on a computer that has Thinkorswim, click on the link, and it'll bring up this chart with this study. Oh, I was going to show you this because it's not just the SPX. It's SPY, any stock. So you could theoretically sell on any stock that has options. But again, remember, you unless you're incredibly rich, you can't sell naked. Well, you can for like a $50 stock if you're selling, you know, $40 puts. You could do cash secured puts, or cash secured calls. But the object of these spreads is to protect yourself on the downside or upside, and give you your max loss. So like I said, I hope this helps. Hopefully you got a little bit of knowledge. I'm going to throw this on YouTube, so I hope you enjoy it. I hope you smash the like button. If you haven't subscribed to the FTM Options channel, please do so. And like I said, comment or reach out to me with questions. I can do my best. But I think if anything to leave you with, it would be you need to respect your stops. So you make $50 a day, let's say, but if you blow out and lose 450, that's what, 9 days that you have to trade this successfully. This is a high probability, high risk trade. So thanks, and we'll talk to you guys soon. Have a good trading week.